Are you ready to learn about one of the most popular investment options? Today we're talking about mutual funds. First of all, let's define what a mutual fund is. Simply put, it's a type of investment vehicle that pools money from different investors and uses that cash to buy various securities, such as stocks, bonds, and real estate. Think of it like a buffet of investments, where you get a little bit of everything. The great thing about mutual funds is that they're professionally managed. That means that a team of finance experts is constantly monitoring the market and deciding where to invest your money. But here's the real kicker. Because mutual funds are made up of a diverse group of securities, they can help reduce the risk of your investment portfolio. It's like having a group of friends at a party where one person spills their drink, but your other friends got you covered. Now, when it comes to investing in mutual funds, you have two options. You can either invest in an actively managed fund, which means that a team of experts will be making decisions on where to invest your money, or you can invest in a passively managed fund, also known as an index fund. These funds track a specific market index, like the S&P 500. One of the most important things to remember when investing in mutual funds is the expense ratio. This is the annual fee the fund charges to cover the cost of managing the fund. The lower the expense ratio, the more your money goes towards actual investments instead of paying management fees. So there you have it, a brief overview of mutual funds. How are mutual funds priced? Now that you know the basics of mutual funds, let's discuss how they're priced. First, it's important to note that mutual funds are priced once daily at the stock market's close. This is known as the net asset value, or NAV for short. The NAV is calculated by taking the total value of securities in the fund and dividing it by the number of shares outstanding. If a mutual fund has $10 million worth of assets and 1 million shares outstanding, the NAV would be $10 per share. It's also important to note that mutual funds can be bought and sold at the NAV, but you may be charged a small transaction fee when you buy or sell a mutual fund. This fee is known as the load. Some mutual funds have front-end loads, which means the fee is charged when you buy the fund, while others have back-end loads, which means the fee is charged when you sell the fund. Now, one thing to keep in mind is that the price of a mutual fund can fluctuate based on the performance of the securities it holds. So, if the underlying stocks or bonds in the fund increase in value, the NAV will increase, and the price of the mutual fund will also increase. Similarly, suppose the underlying securities decrease in value. In that case, the NAV will fall, and so will the mutual fund cost. How are returns calculated for mutual funds? Now that you know how mutual funds are priced, let's talk about how returns are calculated for mutual funds. The most common way to measure the return on a mutual fund is by looking at the change in the fund's net asset value over a period of time. For example, if a mutual fund had a NAV of $10 per share at the beginning of the year and a NAV of $12 per share at the end of the year, the return for the year would be 20%. It's also worth noting that mutual funds often distribute dividends and capital gains to shareholders, which can also contribute to the fund's overall return. Dividends are payments made to shareholders from the fund's income. At the same time, capital gains are the profits from the sale of securities in the fund. Now, it's important to remember that past performance is not an indicator of future performance. The returns of a mutual fund can fluctuate. They may be affected by various factors, such as economic conditions, the performance of the securities held in the fund, and the management of the fund. Additionally, mutual funds have different types of returns, such as total return, which includes both price and dividends returns, or price return, which only considers the change in the mutual fund's price. It's also worth noting that mutual funds are compared with benchmark indices like S&P 500 or Russell 2000 to compare the performance of mutual funds against the broader market. What are the different types of mutual funds? Now that you know the basics of mutual funds and how returns are calculated, let's talk about the different types of mutual funds. Stock funds. These types of mutual funds invest primarily in stocks intending to achieve capital appreciation. They can be further broken down into subcategories, such as growth funds, which focus on companies with the potential for high growth, and value funds, which focus on undervalued companies. Bond funds. These types of mutual funds invest primarily in bonds, intending to achieve income through interest payments. They can be further broken down into subcategories, such as government bond funds, which invest in bonds issued by the U.S. government, and corporate bond funds, which invest in bonds issued by corporations. Balance funds. These mutual funds invest in stocks and bonds to balance income and growth. They can be further broken down into subcategories, such as conservative balanced funds, which invest more heavily in bonds, and aggressive balanced funds, which invest more heavily in stocks. Index funds. These mutual funds are passively managed, tracking a specific market index, such as the S&P 500. They aim to replicate the performance of the index they follow and have lower management fees. Specialty funds. These mutual funds focus on a specific sector or industry, such as real estate, natural resources, or technology. They can be risky but also can give higher returns if the particular sector or industry performs well. It's important to note that many other mutual funds are available, such as money market, international, and target date retirement funds. It's also important to remember that when choosing a mutual fund, you should consider your investment goals, risk tolerance, and time horizon. What are some of the pros of investing in mutual funds? Mutual funds can be a great investment option for many people due to their many advantages, such as mutual funds are professionally managed, which means that a team of experts constantly monitors the market and decides where to invest your money. This can reduce the risk of your investment portfolio, as the fund managers have the knowledge and expertise to make informed investment decisions. Mutual funds provide diversification, as they pool money from multiple investors to buy various securities. Because mutual funds are made up of a diverse group of securities, they can reduce the risk of your investment portfolio. This is because when you invest in a mutual fund, you buy a small piece from many companies rather than putting all your eggs in one basket. Mutual funds are highly liquid, which means you can easily buy or sell shares at the net asset value at any time. Liquidity makes it easy to access your money when needed. You can also easily reinvest your returns into the same or a different fund. Low minimum investment. Mutual funds typically have low minimum investments, which means they are accessible to a wide range of investors, including those with limited resources. Low cost. Mutual funds have lower costs than other investment options, such as individual stocks or real estate. This is because mutual funds are large pools of investments, which allows them to spread out the costs of trading and manage the fund. Wide range of options. Mutual funds come in various types, such as stock funds, bond funds, balanced funds, index funds, and specialty funds, which means that investors can choose a fund that aligns with their investment goals and risk tolerance. Mutual funds are easy to understand and invest in. They are managed by professional portfolio managers and require little time and effort to manage, making them a suitable option for busy people or those with limited knowledge of investing. Now let's talk about some of the kinds of mutual funds. While mutual funds can be a great investment option for many people, they do come with some potential downsides, such as fees and expenses. Mutual funds come with various fees and expenses, such as expense ratios, load fees, 12b-1 fees, and redemption fees. These fees can add up over time and significantly impact the overall return on investment. As an investor in a mutual fund, you have limited control over the specific investments that the fund makes. The portfolio managers make the investment decisions, and you are effectively entrusting them with your money. Past performance is not an indicator of future results. The returns of a mutual fund can fluctuate and may be affected by various factors such as economic conditions, the performance of the securities held in the fund, and the management of the fund. Risk of underperformance. Mutual funds may underperform compared to a benchmark index or other investment options, as the fund manager's investment decisions may only sometimes be successful. Risk of overconcentration. Some mutual funds may have a large percentage of their assets invested in a single stock or sector, which can increase the risk of underperforming funds. Risk of timing. Mutual funds are priced once daily at the stock market's close, which means you may pay a higher price if you buy at the wrong time. Risk of overvaluation. Some mutual funds may be overvalued, which means that the fund's securities are priced higher than their actual value. This can lead to a lower return on investment. It's important to remember that mutual funds also come with risks and potential downsides. It's essential to consult with a financial advisor to understand how mutual funds may fit your overall investment plan and to choose the fund that best aligns with your investment goals, risk tolerance, and time horizon. Can mutual fund shares be sold at any time? Yes, mutual fund shares can be sold at any time, but it's essential to keep in mind that the price at which you sell your shares will depend on the net asset value of the fund at the time of the sale. Mutual funds are valued once per day, typically at the end of the trading day, and the NAV is calculated based on the value of the underlying securities held by the fund. When you sell your shares, the mutual fund company will redeem them at the NAV when the request is processed. Remember that some mutual funds may have redemption or short-term trading fees if shares are sold within a short period after purchase. These fees are intended to discourage the short-term trading of a fund's shares. It's also important to note that while mutual funds are highly liquid and can be very easily bought or sold at the NAV, the market conditions can change. Depending on the market conditions and the fund's performance, they may only sometimes be able to sell the shares at the same price you purchased them. In conclusion, mutual funds are a popular investment option that can provide professional management, diversification, liquidity, and accessibility to a wide range of investors. They come in different types, such as stock funds, bond funds, balanced funds, index funds, and specialty funds, each with advantages and disadvantages. However, it's essential to remember that mutual funds come with fees and expenses, and that the returns can fluctuate and may be affected by various factors such as economic conditions, the performance of the securities held in the fund, and the management of the fund. It's always recommended to consult with a financial advisor to understand how mutual funds may fit in your overall investment plan and to choose the fund that best aligns with your investment goals, risk tolerance, and time horizon. Thanks for watching Wealthy Ways, and stay tuned for more educational content on investing and personal finance.